Talk to us about how you make this inflation pressure we see across the market. We hear it from the Treasury market, as Taylor outlines. What does it mean for your world of equities and alternative assets?
Yeah, I think today it's clearly been all about slowing growth, rising inflation. You clearly see that markets are now processing the unintended consequences of really economic warfare, right? With the sanctions on Russia intensifying, it's hitting all sectors. Investors are looking at the effects of this across longer-term inflation, especially food and energy prices. Renewed supply chain disruptions are factoring back into inflation. And then you're going to have some central bank actions amidst a much more uncertain economic growth. And I think that is now clearly hitting equity markets, and we're going to continue to see this challenging and turbulent year continue, given all of these different price movements that have been at the extreme across commodity markets, equity markets, and the like.
When we talk about what's being priced into this market, are we now talking about the potential for a recession or at least for a significant economic slowdown?
Yeah, I mean, I think even just a few weeks ago, right, investors were still in the mode that inflation, while elevated, could come down significantly from these levels. But the timeline, I think, just keeps getting pushed out as events continue to materialize and worsen in Ukraine. And what may end up happening is that this just moves us even faster into a scenario of stagflation, or at the very least, a sluggish economy that just kind of tries to hang on there. We have weaker demand, and there's not a lot, unfortunately, that central banks are going to be able to do to hopefully, see if we don't end up into a recessionary period. So I think we're going to be watching really closely for example, the ECB meeting this week to see if they have any changes to their growth outlook and what this could potentially mean for monetary policy. Monetary policy was already one of the more central themes going into 2022, and now all investors' eyes are going to really be focused on how are central banks viewing this latest uncertainty.
For the markets and correlations, it was interesting. BlackRock was out with a note that in demand shock environments, you get that negative correlation between equities and bonds. But if we're in a supply shock, as we are in now, you actually get positive correlations and a breakdown of diversification. Do you see that as well?
Yeah, and that's been, something that we've been grappling with right on and off for the last couple of years as we've been moving into this period of higher interest rates that we were all anticipating. I do think, though, when we look at portfolios, we are maintaining a very high level of diversification where we can, knowing that correlations break down at certain points in the cycle. But we came into the year with positions, for example, in gold. We're hedging to the dollar. There are other ways to hopefully protect and profit from some of the rising interest rates that we're seeing, from the inflation, from commodity prices, and from what input prices are going to do to earnings, down the road. So I think diversification continues to be key in our portfolios, even if correlations are rising.
Alifia, I'm not going to ask exact percentages, but when you've got 15 billion in assets under management, how much of that needs to be in cash so you can be nimble, you can be swift, you can be reorientating the portfolio?
Yeah, that's a great question. And we have been really looking for ways to increase our dry powder because we do think that there are going to be immense opportunities. And, maybe not at the moment where we're seeing so much heightened uncertainty and where we're seeing, prices from nickel to palladium to all the inputs into the sectors that we're investing in really rise. But we do think down the road, we're going to need to have a lot of dry powder. And so we are at slightly elevated levels of cash, and that's going to continue throughout the year as we start to see, hopefully more opportunities that we can then try to take advantage of.
Do you use more than just cash as a cushion? Where else do you hedge?
We do have a slight ballast in our fixed income exposure, and our fixed income exposure, we've actually tried to diversify and eke out a little yield, even though it's been a bit of a tailwind. So there are places that we have been able to find to be able to, keep a little bit of dry powder, keep a little bit of liquidity, and be able to be flexible and nimble, because we think that is key this year as we see what's going on in the markets.
Are widening credit spreads expected, or telling you something that is going on with the fundamentals?
We haven't seen it yet. We've talked to a lot of investors that are looking for more of those distressed opportunities. We could start to see that depending on, I think, what happens to corporates and what happens to earnings down the road. So we are, cautiously on the sidelines looking for some of those opportunities, but I think it's still a little too early to see where this heads.
And just talk to us, Alifia, about Rock Creek, how focused they are on the US outperforming, or how much it is important to be diversified elsewhere.
So we are 100% diversified across regions, but we have been slightly overweight to the U.S. For the last, I would say, at least several months coming into 2022. We were already a little hesitant on emerging markets, even though valuations in the equity markets looked quite attractive. We have some really good positive, biases in ASEAN countries that have been working out really well in the emerging markets, but still an underweight to emerging markets and overweight to U.S. Europe, a little bit of an unknown. I'll tell you honestly, we thought that Europe would be a little bit more attractive before we got into this scenario. And now we're rethinking how will Europe play out over the longer term.
Do you worry at all that we might be facing down a much more fractured global economy than what we had a couple of years ago?
I think it's inevitable that we're going to start to see some of this impact really ripple through longer term, right? I mean, you just see that food prices, there's been such a focus on oil, but what about food prices? Food prices have surged, and Ukraine is a leading supplier for many lower income countries. If farmers in the Ukraine aren't able to plant wheat for their crops next year, that's not a problem this year, that's a problem next year. And so to your point, globally, this is really going to have long-term implications in terms of some of the traditional linkages breaking down.
And do you expect, position for just higher volatility on the horizon?
Yeah, we have really been trying to, again, be flexible, be nimble, and really kind of look and see where we can be ready to pounce in terms of opportunities in the market, but probably a little bit too early today. But I think, that's one thing when we look at institutional investors and their positioning, you do get a little bit worried about some of those portfolios, larger portfolios out there that had a lot of private investments and don't have a lot of dry powder today, because this is probably the year where you're going to want some of that.